Let's turn our attention back to the markets now. We are seeing the S&P 500 hovering above that 4,000 level. Our next guest says there is much more upside ahead. That he says, in his words, the rip through 4,000 is not the start of the speculative blow off. Let's bring in Julian Emanuel, BTIG Chief Equity Derivatives Strategist. Julian, I'm going to hold you to that comment here. Walk me through what you see that signals that.
So there are sort of really three elements that lead us to believe that you're not in this sort of speculative, maybe even call it mania stage, like we were at the end of 1999, 2000, at the tech bubble. The three things, first off, it is very clear from looking at over 100 years worth of market history that stocks do not like higher taxes. And I think that if we aren't yet getting used to the idea that we're going to have higher taxes, we need only listen to President Biden this afternoon to be reminded of that. On average, in years where higher taxes are announced, passed into law, the market underperforms by 500 basis points, still slightly positive. And the year after, when the tax bills come due, the market actually declines slightly. So from our point of view, when you combine that with this idea that the manufacturing ISM and the services ISM are so incredibly strong that it's going to necessitate the Fed, if not the Fed, then the market itself rethinking the speed and timing of Fed starting to unwind its ultra-loose monetary policy. And then the third thing is very much look around us. The weather's turning nice. The economy is reopening. And people who have been behind their screens for the last year, many of which are new to the markets and really have fueled the boom in stock trading volumes and in the upside in the markets, they're going to step away and they're going to spend their money rather than invest it over the next 6 to 12 months. And that ties into Jamie Dimon's comments about the potential for the economy to boom. It doesn't necessarily mean that in the medium term, that's a positive for stocks.
Well, Julian, that's why it's so tricky to kind of try. That's why I'm not envious of the position you and other strategists are in to kind of try and project where we go from here, because normally I would point to maybe the idea that people will be getting away from their screens. So that means some speculation is going to decrease as hogwash. But we, of course, saw that happen with GameStop, and we saw it happen with kind of this retail boom. But when it comes to reopening, then, if that is going to be the case and everyone is going to deliver on what is already lofty expectations for increases in the latter half of the year, talk to me about maybe the spots of the market that might be under calculating how big that return to normal might be. We're going to be talking about cruise lines, but what other things out there sector-wise are you watching as maybe those ones that do have the largest room to run?
Well, we actually think that there's a divergence of outcomes between the near term and the longer term. Longer term, we think these reopening plays, call them value stocks, call them deep cyclicals, financials, energy, cruise lines, lodging, things like that. Those are going to go higher in the longer term. We think in the very near term, however, that those have gone a little bit too far ahead of themselves, perhaps. And actually, we think the areas in the market that have been largely ignored for the last several months. I go back to about a month ago when we warmed up to large cap technology for the first time since last summer. It was, very much hated. The last month has seen a turnaround in that area. We think there's more upside to go because their earnings season is going to be positive. And then another area of the market that we like actually is healthcare. Healthcare has been caught in this cross current of politics. Essentially, what you have is an expectation that there are going to be punitive legislation with regard to healthcare, but it's already trading at an historic discount to the market with good, solid earnings power. Looking into 21 and 22, we think there's room to run there.
And Julian, real quick on the question of speculation and kind of that excitement in the market, again, to your point, not necessarily seeing the bump in the last round of stimulus checks that maybe some people were expecting to come into the market. But another one of those speculative measures we always look at is Bitcoin, and that's kind of traded sideways at that 60 grand level. You've talked about Bitcoin for a bit here, but where do you see things going there for the rest of the year, given if we are going to see maybe some of this speculation unwind?
Well, first thing, we are believers that Bitcoin is a diversifier, is an asset class, is a store of value, and that's likely to increase as time goes on. Now, again, the near-term picture is somewhat different. What you've had over the last several months are a proliferation of the ways to invest in cryptocurrency. Non-fungible tokens, NFTs, have become, very, very popular. There have been many more funds, publicly listed entities where you can invest in crypto. And then, of course, more cryptocurrencies themselves, all of which has drawn investing dollars perhaps away at the margin from Bitcoin itself. And so we think this is just sort of a digestive process as the supply and the demand of investing in cryptocurrency catches up with itself. Frankly, we wouldn't be surprised if Bitcoin trades down to the lower end of the range, since we are likely to have several new offerings into the public market in coming weeks.
We'll have to have you back on if we see those moves. Julian Emanuel, BTIG Chief Equity Derivatives Strategist.